Topic expands the discussion of active equity management by introducing several specialized strategies that seek to generate excess returns beyond traditional value and growth investing. These approaches include activist investing, event-driven investing, statistical arbitrage, and market microstructure strategies. Each strategy attempts to exploit specific market inefficiencies, corporate events, or pricing anomalies that may not be fully reflected in security prices. Unlike broad market approaches, these strategies often rely on unique catalysts, specialized expertise, or sophisticated analytical techniques. Portfolio managers employing these methods seek to create alpha through active decision-making, while carefully managing the risks associated with concentrated positions, uncertain outcomes, and rapidly changing market conditions. Activist investing involves acquiring a meaningful ownership stake in a company and influencing management decisions to enhance shareholder value. Activist investors typically target firms that they believe are underperforming due to inefficient operations, poor capital allocation, weak governance, or strategic missteps. After acquiring shares, they may advocate for changes such as asset sales, share repurchases, dividend increases, management replacements, or corporate restructurings. The investment thesis depends on the belief that managerial actions can unlock hidden value and improve financial performance. Although activist investing can generate substantial returns, success requires significant resources, patience, negotiation skills, and the ability to influence stakeholders while navigating regulatory and governance challenges. Event-driven investing focuses on corporate events that may create temporary mispricing opportunities. Common catalysts include mergers and acquisitions, spin-offs, restructurings, bankruptcies, recapitalizations, and regulatory decisions. Managers analyze the probability of an event occurring and assess whether market prices accurately reflect potential outcomes. Merger arbitrage is a prominent example, where investors purchase shares of a target company while potentially shorting the acquiring company to profit from deal completion. Event-driven strategies require extensive legal, financial, and strategic analysis because investment outcomes depend on uncertain future developments. Successful managers combine valuation expertise with a deep understanding of transaction structures, regulatory considerations, and market expectations. Distressed debt investing represents another specialized active strategy focused on financially troubled companies. Managers seek opportunities in securities trading at substantial discounts because investors fear default, bankruptcy, or restructuring. The strategy is based on the belief that market participants may overreact to adverse news, creating opportunities to acquire securities below their intrinsic value. Investors analyze capital structures, asset values, recovery rates, and restructuring scenarios to estimate potential returns. In some cases, debt holders may ultimately receive equity ownership following reorganization. Although distressed investing can produce significant gains, it involves elevated credit, liquidity, and legal risks, requiring extensive expertise in restructuring processes and insolvency frameworks. Statistical arbitrage and market microstructure strategies rely heavily on quantitative methods and advanced data analysis. Statistical arbitrage seeks to identify temporary deviations from historical pricing relationships among securities. Managers construct models that detect anomalies and implement trades designed to profit when prices revert toward expected levels. Examples include pairs trading and mean reversion strategies. Market microstructure strategies focus on trading behavior, liquidity dynamics, order flow, and transaction costs. These approaches attempt to exploit short-term inefficiencies arising from the mechanics of financial markets. Because opportunities are often fleeting, success depends on robust technology, disciplined execution, sophisticated risk controls, and continuous monitoring of evolving market conditions. Topic examines equity investment style classification, a framework used to categorize investment managers according to their investment characteristics and behavior. Style analysis helps investors evaluate performance, compare managers, and ensure portfolio diversification across different approaches. Broad style categories include value, growth, blend, small cap, mid cap, and large cap strategies. Understanding a manager's style is critical because performance varies across market cycles, and apparent outperformance may simply reflect favorable style exposure rather than superior security selection. Effective style classification enables investors to distinguish genuine skill from factor-driven returns and supports more informed manager selection and portfolio construction decisions. Two primary methodologies are used to classify investment styles: holdings-based analysis and returns-based analysis. Holdings-based analysis evaluates the actual securities held within a portfolio and aggregates their characteristics to determine style exposure. This approach provides detailed, forward-looking insights into portfolio composition and factor exposures. Returns-based analysis, in contrast, examines historical portfolio returns and uses regression techniques to estimate exposure to various style benchmarks. While returns-based analysis requires less information and can be applied when holdings data are unavailable, it is inherently backward-looking. Both methods provide valuable information, and investment professionals frequently use them together to gain a more comprehensive understanding of portfolio behavior. Style classification plays a vital role in performance evaluation, risk management, and manager oversight. Investors use style analysis to verify whether managers remain consistent with their stated mandates and to detect style drift, which occurs when portfolio characteristics deviate from intended exposures. Monitoring style consistency helps maintain strategic asset allocation objectives and improves manager accountability. Additionally, style classification enhances portfolio diversification by ensuring exposure to complementary investment approaches rather than unintentionally concentrating risk in a single style category. By understanding activist, event-driven, distressed, and quantitative strategies alongside the principles of style analysis, investment professionals can better evaluate active managers and construct portfolios aligned with long-term investment objectives.